For example, suppose the government were to pass a law requiring all washing machines and laundromats to have a washing cycle at least 45 minutes long to protect customers from insufficiently washed clothes. The laundromat owners, being unable to serve as many customers per washing machine as before, would take in less money. This would prevent them from buying more and newer washers and dryers, which would hurt the manufacturers of these products, who would then be unable to buy as much steel and porcelain, etc., etc. At the other end of the line, the customers of laundromats would also be hurt, as the shortage of available washing machine time developed due to the original 45-minute regulation, plus the laundromat owners' inability to buy new machines and replace worn-out ones. At this point, some government bureaucrat is sure to call for federal action to deal with the crisis in the laundromat industry caused by the excesses of an unregulated market. In this way, people who are naturally already doing business in the most profitable way for both seller and buyer — remember, we're talking about a free, competitive market — are forced by government regulation of the market to act differently, which causes them losses. Advocates of government regulation usually accept the idea of imposing some losses on those who are regulated, but they fail to take into account the fact that those losses will inevitably diffuse throughout the economy like ripples spreading in widening circles over a pond. They also fail to recognize that a society with government regulation is dangerous to every individual person because anyone may be the next victim, directly or indirectly, of government controls. But even though government regulation of the market necessitates the initiation of force and causes widespread losses, many people still feel it's necessary to force some sort of order on the seeming chaos of the market. This belief stems from a complete misunderstanding of the way in which the market functions. The market is not a jumble of distorted and unrelated events. Instead, it's a highly complex but orderly and efficient mechanism which provides a means for each person to realize the maximum possible value and satisfaction commensurate with his abilities and resources. A brief examination of the workings of the market will illustrate this point. A complete proof of it would require several hundred pages of economic analysis. The price of any good on the market, including such things as a doctor's fees and the rates of interest on borrowed money, is determined by the supply of the good available relative to the demand for it. Within the limits of available resources, the supply is controlled by the demand, since producers will produce more of a good in order to increase their profits when customers demand more and are thus willing to spend more for it. So it is consumer demand which really calls the tune in a free market. Consumer demand is the aggregate result of the economic value judgments of all the individual consumers. Thus, it is the values of the individuals expressed through their demand for various products which cause the market to be what it is at any given time. The price of any good on the market will tend to be set at the point where the supply of that good, at that price, is equal to the demand for it, at that price. If the price is set below this equilibrium point, eager buyers will bid it up. If it is set above, the sellers will bid it down until it reaches equilibrium. At the equilibrium price, all those who wish to buy or sell at that price will be able to do so without creating surpluses or shortages. If, however, the price is artificially lowered by a government price control, more buyers will be attracted while sellers will be unwilling to sell, creating a shortage, with its attendant problems of rationing, queues, and black markets. On the other hand, if government sets the price higher than the equilibrium price, there will be a surplus of the good, bringing financial ruin to those who are unable to sell their excess stock. A specialized example of this occurs in the labor market whenever government or government-privileged unions forces a minimum wage higher than the equilibrium wage, leading to a surplus of labor and so causing unemployment problems and an increase in poverty. And this is only one way in which the government causes unemployment and poverty. Thus, the market has a built-in self-regulating mechanism which continually adjusts the price of products, and similarly their quantity and quality, to the supply of available resources and to the amount of consumer demand. It works like a complex signal system, visible to all and reliable if not interfered with. The signals are given by consumer value choices. They are transmitted to the sellers, businessmen and entrepreneurs, by means of profit and loss. A profit tells the businessman that consumers are pleased with his product and that he should continue or even increase the level of production. A loss shows him that not enough consumers are willing to buy his product at the price he's asking, so he should either lower his price or redirect his money and effort into some other line of production. This signal system keeps the market constantly moving toward equilibrium, even as new data enter and upset the previous balance. For example, suppose that Eastern Electric begins manufacturing a newly invented TV tube, which shows the picture in 3 dimensions. As consumers hear of the new 3D TV via news reports and advertising, demand for it skyrockets. The number of 3D TVs Eastern Electric can produce is limited, so the large demand and small supply result in an extremely high price and high profit margins for Eastern Electric. But this same high profit, which may seem at first to be an instance of market imbalance and unfairness, is the signal which moves the market toward equilibrium. Eastern Electric's high profits stimulate other firms to do research on 3D TV so that they may enter the field with new and better models and share in the profits. Soon, half a dozen firms are selling competing 3D TVs, and the increased supply satisfies the demand. This brings the price down until high profits disappear and earnings in the 3D TV industry are about the same percentage-wise as in every other industry. At this point, new firms stop entering the field as there's nothing more to attract them. The whole market levels off and, barring another new input of data, remains stable. Thus, when the market is unhampered, any new input of data immediately sends out profit or loss signals, which set in motion factors which maintain market equilibrium. The market is a self-regulating mechanism. It should be noted that the high initial profit realized from a new product is also a just process in which the innovator is rewarded for his investment of time, money, and mental labor. Individual self-interest is the basis for the whole market system, which is why it works so well. The consumer acts in his self-interest when he buys things at the lowest prices and with the best quality he can find. The producer acts in his self-interest in trying to make the highest profit possible. Both consumer and producer attempt to profit from their market transactions. If either side didn't expect to gain, no trade would take place. This double utilization of the profit motive results in maximum consumer satisfaction and rewards entrepreneurial efficiency. Government affects the economy in three major ways. Number one, by taxation and spending. 2, by regulation. And 3, by control of money and banking. Taxation is economic hemophilia. It drains the economy of capital, which might otherwise be used to increase both consumer satisfaction and the level of production, and thus raise the standard of living. Taxing away this money either prevents the standard of living from rising to the heights it normally would, or actually causes it to drop. Since productive people are the only ones who make money, they are the only ones from whom government can get money. Taxation must necessarily penalize productivity. Some people feel that taxation really isn't so bad because the money taken from the private sector is spent by the public sector, so it all comes out even. But though government spends tax money, it never spends this legally plundered wealth the same way as it would have been spent by its rightful owners, the tax-paying victims. Money which would have been spent on increased consumer satisfaction or invested in production, creating more jobs and more products for consumers, may be used instead to subsidize welfare recipients, controlling their lives and thus discouraging them from freeing themselves in the only way possible, through productive labor. Or it may be used to build a dam which is of so little value to consumers and investors that it would never have been constructed without the force of government intervention. Government spending replaces the spending which people, if free, would do to maximize their happiness. In this way, government spending distorts the market and harms the economy as much or more than taxation. If taxation bleeds the economy and government spending distorts it, governmental regulation amounts to slow strangulation. If a regulation requires businessmen to do what consumer desires would have caused them to do anyway, it's unnecessary. If it forces businessmen to act against consumer desires, which it almost always does, it harms the businessman, frustrates the consumer, and weakens the economy. And the confused consumer can usually be propagandized into blaming the businessman. By forcing businessmen to act against consumer desires, government regulation increases the cost of the regulated products, which in our present economy includes just about everything, and so lowers living standards for everyone and increases poverty. Government regulation not only hurts the poor indirectly by raising prices, but directly as well by denying them opportunities to move up and out of their poverty.